Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to the Deep Dive, where we sift through the sources, extract the actionable intelligence, and give you that strategic advantage.
Today we're really getting into the engine room of M&A.
We are. We're focusing on the often overlooked but incredibly dynamic space of the lower middle market, the LMM.
And this is where, the true backbone of the economy, these high-quality small and mid-sized businesses, are bought and sold.
Often for life-changing sums of money. And for anyone listening who owns, operates, or invests in a business, say, under $50 million in enterprise value, this is for you.
Absolutely. Understanding the temperature of this market right now is, it's non-negotiable. It's where capital is flowing. It's where huge investment firms are shifting their focus.
And it's frankly where a lot of founders see the culmination of, decades of work?
Exactly.
So our mission for this deep dive is pretty clear. We're going to distill the critical intel on market dynamics, investor sentiment, and this is the important part. Give you a concrete roadmap for planning a successful exit.
And we should give credit where it's due. A lot of these insights come from some really detailed analysis prepared by Eddie Riva, focusing on what was happening around the first week of August 2025.
Okay, let's unpack this. So let's jump straight into the central puzzle of the LMM today. We have this paradox.
It really is a tale of two markets.
On the one hand, the market is undeniably slower. You see signs of real contraction. But on the other, when a high-quality business actually goes to market, it's commanding these robust, sometimes surprising valuations. So what gives?
The caution is real, and the raw numbers, they really bear that out. Our sources are showing that M&A deal activity in the first quarter of 2025, it dropped significantly.
How significant are we talking?
We're talking 60%. A 60% drop compared to just the previous quarter, Q4 of 2024.
Wow, 60% is.
Yeah.
That's an absolute cliff dive. That shows just how wary buyers are feeling.
It's huge, and it signals that this general uncertainty is causing buyers to just, pause.
But even with that drop, I saw that something like $12 billion in total M&A volume still flowed through the LMM in that same quarter.
Correct. So money is still moving. It's just that the number of transactions is way, way down.
So why? What's the core reason for the brakes being slammed like that?
It really stems from this generalized uncertainty, things like tariffs and trade policy. This creates what we call valuation compression.
Right, a gap in expectations.
Exactly. A seller knows their company is worth, let's say, X. They're not willing to just drop their price, but the buyer is hedging against all this risk, so they're unwilling to pay X.
And that misalignment, that's what slows everything down.
It slows deal velocity dramatically.
Okay, so if the total number of deals is down 60%, but the valuations for the few deals that do close are still strong, that tells me we're talking about an incredibly discerning market.
That's the perfect word for it.
It sounds like only the absolute top-tier businesses are making it across the finish line.
The market is distinguishing very sharply between premium assets and, everything else. When we say high valuations, we're talking about EBITDA multiples.
So just for our listeners, that's the buyer paying a multiple of the company's annual profit, right? Before interest, taxes, and all that.
Precisely. Maybe 6 or 7 times that profit number. And those strong multiples are still being commanded because the demand for truly quality assets, that hasn't diminished at all.
That makes perfect sense. In a nervous climate, capital always chases safety and predictability. So which sectors are offering that safety right now? Which ones are defying this slowdown?
We're seeing 3 sectors with persistent resilience, really across all deal sizes. You've got healthcare.
Obvious choice, recession-proof.
Exactly. Then you have technology, and finally, domestic industrials.
Okay, so tell me what's so fascinating about those 3 in particular.
What's fascinating here is why they defy the slowdown. It's about their intrinsic characteristics. For technology, buyers want businesses with proprietary IP or a really defensible niche. Think recurring revenue models.
Subscription services. Sticky customers.
Exactly. With healthcare, as you said, the demand is essential. And with domestic industrials, well, these are the companies that are shielded from all that trade uncertainty we mentioned.
Because their supply chain and their customers are all right here.
That insulation is what buyers are paying a premium for right now.
That immediately translates the macro trend into a micro piece of advice, doesn't it? If you're a founder and your business isn't in one of those hot sectors, you better be able to explain very clearly how your supply chain is insulated.
Or you'll face that valuation compression head on.
Okay, let's pivot. Let's talk about the forces driving the demand side. We know what they're buying, but who are the big players and what's motivating them?
The LMM space is increasingly dominated by serial acquirers and aggregators.
For roll-up specialists.
Right. These are firms often backed by huge capital designed to just roll up highly fragmented markets like specialized B2B services or certain software verticals. They are transaction machines.
But it's not just them. I imagine larger corporations are looking downstream too.
For sure. A lot of large corporations are finding that their own organic growth is just stagnating. They can't grow fast enough internally to keep shareholders happy.
So they go shopping.
They go shopping in the LMM to achieve synergy, to immediately boost their top line. It's often just cheaper and faster to buy growth than to build it.
And the capital environment helps. Even with rates being a bit higher, it's still relatively cheap to borrow.
Absolutely. When borrowing costs are manageable, and historically they still are, it just reduces the friction for making a deal. A deal that looks too expensive with 8% borrowing suddenly looks great at 5%.
Now let's talk about the elephants in the room. Private equity. We've heard about this massive pivot. Is PE really shifting its gaze from the huge deals down to smaller acquisitions?
Without a doubt. Large cap PE firms are looking at the middle and lower middle market as like the new frontier.
Why is that?
They see the upper market as overheated. It's overpriced. The returns are diminishing. But the LMM, it still contains these highly scalable businesses that haven't been professionally optimized yet. That's where they see the real opportunity to generate alpha.
And the data backs that up.
Yeah, our data suggests over 75% of them are actively planning an expansion into this segment.
Okay, here's where it gets really interesting for me. The capital. You have to talk about that overwhelming force known as dry powder.
Dry powder is the single biggest indicator of pent-up demand. It's committed capital that's been raised by these funds but hasn't been invested yet.
And the number is just astronomical.
It's approximately $2.6 trillion.
Yeah.
Just sitting there, waiting.
2.6 trillion. To put that in perspective, that's a tsunami of capital that actually has a shelf life, right? They have to deploy it.
They have to. Those investment deadlines are approaching, and the firms holding that money, they are under intense pressure to put it to work. That pressure alone is driving them to be more aggressive in chasing LMM assets.
That explains the optimism then, doesn't it? Even if the macroeconomy is a bit murky, the sheer weight of capital that must be deployed means that deals must happen.
Precisely. And that's why 60% of the current LMM players feel optimistic about the second half of 2025. They see that wave of capital coming.
What about financing? Are banks getting nervous?
A little, but we've seen private credit really step up to fill any funding gaps. It ensures deals can get done even if interest rates stay a little elevated. The capital is creative. It finds a way.
So we have hungry buyers and endless capital. Let's flip to the supply side. What's driving so many founders to decide that now is the time to sell?
The supply is being driven by these two really powerful currents. The first is demographic.
The baby boomers.
The baby boomers,
Yeah.
exactly. Many LMM firms were started by them, and they are simply ready to retire. They need an exit plan.
And the second current.
The second is a critical regulatory catalyst. There's immense urgency being driven by the impending sunset of the estate tax provisions.
The ticking tax clock.
It's a huge motivator. Many owners know that the current, more favorable tax environment for selling their assets could change. That encourages them to structure an exit before their potential tax bill goes up.
So you combine that tax clock with the fact that many of these longtime owners don't have a formal succession plan.
And selling to a sophisticated buyer suddenly becomes their most viable option. It creates this powerful but finite supply wave hitting the market.
What are those sellers looking for in a buyer? Is it just the highest price?
Not at all. They know what they need. When they look for a partner, they specifically want buyers who can bring in new technology to streamline their operations and enhance distribution to scale their business beyond its current limits.
So we've laid out this robust opportunity. But we need to shift from this macro analysis to, practical steps. A founder listening to this who decides to go for it needs to understand that success is proportional to preparation.
It's not a quick decision. It's a detailed campaign.
That's the part that gets lost in all the data, isn't it? The human element. The idea of selling a business you poured 20 years of your life into it's emotionally and strategically daunting. Where does a founder even begin?
The first, most critical step is an honest self-assessment. We call it the initial readiness check.
Readiness. So operationally, financially.
All of that, but also emotionally. Are your key managers ready to transition to a new owner? Are your systems actually documented? And are you emotionally prepared to let go of your identity as the person who runs this company?
I can see how skipping that step would lead to a lot of pain and broken deals down the line.
It happens all the time.
Okay, so once that internal readiness is confirmed, the focus has to shift to maximizing the value a buyer will see. What's the single most impactful thing a founder can do there?
It's the importance of sell-side due diligence.
So you're basically doing the buyer's homework for them, but on your own terms.
Exactly. You hire an advisor to audit your own company proactively. You find all the risks, all the legal loopholes, all the financial red flags. You find them before the buyer does.
Because every surprise the buyer finds is leverage for them to knock the price down.
Every single one. By finding and fixing these issues yourself, cleaning up old contracts, documenting your IP, you control the narrative. You control the story of your company's value, and that leads to a higher price.
That makes so much sense. Don't wait for them to poke holes, patch them yourself. But once that value is maximized, how does an owner choose the right partner? It can't just be about the check.
It absolutely cannot. Buyers have to be evaluated on the holistic fit. Price is, of course, paramount, but you have to look at the cultural aspect.
Like their leadership style, will they move the factory?
Yes. And their specific experience in your sector. A buyer who knows your industry is far more likely to integrate the business successfully and, crucially, pay out any earnouts down the road. They'll preserve the value you built.
And as we touched on, a full 100% sale isn't the only path.
Correct. Owners have to consider all the strategies. You might look at a hold and grow strategy, where you partner with PE for a capital injection to scale, but you keep a minority stake.
Or sell off a non-core division.
A partial divestiture, right? To fund growth in your main business. The strategy has to be tailored. It's not one size fits all.
So for the listener who's thinking, okay, I want to do this, I want to sell in the next few years, we need to give them a tangible structure.
And that's where we get to the 1,000-day plan. It's a concrete, staged timeline that is just necessary for a successful exit.
The 1,000-day plan. All right, walk us through those critical milestones.
The clock starts 1,000 days out. That's almost 3 years. This initial period is your buffer. It's all internal preparation.
Like what?
Preparing your family for the transition, streamlining operations, making sure your financials are GAAP compliant, and building strong management depth so the business doesn't just depend on you.
Getting your house in order.
Exactly. Then, at about 18 to 15 months out, that's your research and hiring phase. This is when you engage your key advisors, your M&A banker, your specialized attorney, your tax professional.
You don't wait until you have an offer.
Please do not wait. These are the professionals who guide the preparation.
But we get closer and the focus narrows.
Yes. At the 12-month mark, you're preparing all your marketing materials, your confidential information memorandum, and you're identifying that pool of potential buyers. The final 6 months is the sprint.
LOI, due diligence, closing.
Right. Letter of intent, the rigorous due diligence process, negotiating all the final details, and then closing the transaction.
This raises an important question for me. If this process is so complex and so staged, why do so many owners still wait until they're maybe 6 or 9 months out from when they want to sell to even start?
Because they underestimate the sheer necessity of this multi-year preparation. And waiting, it guarantees you leave value on the table, often hundreds of thousands, if not millions of dollars.
That staged approach really drives home the need for strategic patience. So, after all this, what does this all mean? Let's recap the fundamental truths here.
Okay, first, the LMM M&A market is slower, no doubt. That 60% drop in volume is real, driven by uncertainty. But deals are absolutely still happening for the right companies. $12 billion in Q1 proves that.
Second, the demand side is ferocious. Investor sentiment is improving for the back half of 2025, and you have that monumental $2.6 trillion in dry powder just waiting for a home.
Third, quality reigns supreme. High-quality businesses, especially in those resilient sectors, tech, healthcare, domestic industrials, are still commanding strong multiples. Premium assets are scarce.
And finally, for the founder listening, the blueprint is the 1,000-day plan. Early planning, aggressive sell-side due diligence, and getting expert advisors on board early. Those are the keys.
And we highlighted that the supply side, driven by these finite factors of aging owners and that estate tax clock, it's poised to peak. This means the window of opportunity for owners is unique, but it might be short-lived.
So for those considering selling their business, the biggest decision they face today may not be if they should sell, but when they commit to starting that 1,000-day timeline to maximize their value, before that market supply potentially peaks and the intense pressure to find quality assets starts to dissipate.
That's the takeaway.
Thanks for diving in with us.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.